Good day, ladies and gentlemen. This is Barry Norman on behalf of USG FX, Australian Forex Marketplace provider, one of the world's leading providers, and we're going to be talking about day trading today. So today's class is, like I said, sponsored by USG, and they offer trading in Forex, commodities, indices, and they are an Australian regulated broker. And they are one of the few and one of the leading platform providers in the world. So you know when you trade with them, because they are regulated by the Australian Commission on Securities and Investment, that all funds are segregated. All your deposits are, and all your withdrawals are very, very quick and processed very fast. And there's ultra-fast execution of trades. There's also negative balance protection. And of course, you have the protection of one of the most respected regulators in the world. Now, you also have a lot of tools offered to you by USG. You can use trading central signals. You can use Zulu Trade, and you get my FX book for social trading platforms. Now, USG has been awarded many awards over the years, and they've been nominated and named the best Forex broker in Australia in 2015, 2016, and now again for, it looks like they're going to be, they were nominated, it looks like they will be the leading broker for 2017. They offer a wide variety of services and platforms. So, number one, USG is a market-leading online brokerage firm for currency and CFD traders. So it's all-inclusive when you trade there. They are headquartered in Sydney, so if you're located in Australia, you're welcome to stop by their offices in Sydney. They offer 60 different foreign exchange pairs, or Forex pairs. They offer commodities, indices, equities in CFD format. You can trade gold, silver, and oil with them. They've been in business since 2006. That was the beginning of the Forex revolution. So you know that they've been around for a long time. And again, they are a regulated broker with their license number being 302792. You can use MT4 and MT5 platforms. You can use social trading. You can use MetaTrader mobile. You can use their online web trader or multi-terminal. So you decide what type of trading is best for you, and you decide what platform you would like to trade on. They also offer all of their traders daily technical reviews, signals generated directly from the MT4 platform. They have all kinds of online technical research, and they also have live Forex TV. Now, they also have their VIP access and their Traders Club program, which offers many advantages to traders and keep you on top of the market and keep you the best educated possible. Now today, we're offering a webinar special. If you deposit $5,000 or more, you will get a lot of free access that is usually for the VIP class or the Master Trader class. And you will also get a $500 bonus. And this is for webinar attendees today only. So if you decide to open an account, or go to www.usgfx.com, and you can open a demo account right away, and you will then get the automatic benefits of registering during the webinar. Now, today's webinar is being recorded, and if you want to use or watch this at a later date after today's class, simply use the link you use to attend today's class, and it will take you to the recorded version. The recorded version is usually available within 24 hours, but not immediately. So don't go right after class, click on the button and expect it to be there. It takes a while to be processed and checked and everything else. But give it a little bit of time and you'll be able to access it with that same link. So today we're going to be talking about day trading. And there's a whole bunch of fallacies out there, a whole bunch of misinformation, a whole bunch of bad marketing when it comes to day trading. But some people can be very successful while others are total failures. Now, I remember a few years ago, now I was an agricultural trader for many, many, many years before we had online brokers. In fact, it was 40 years ago I was trading in Chicago. Now, all of a sudden in the 1990s, we got this big press press covered all of you, because we were just starting with some online trading. There were big things about penny stocks, all kinds of, and all of a sudden you were seeing pictures of people laying on the beach saying they were day traders, quitting their jobs and making tons of money. Well, come on, guys, we know that doesn't happen. Now, I see a lot of people who make money consistently, though, by day trading. These are not Johnny-come-lately types jumping on a fad fueled by bullish tape. They bear no resemblance to the secretaries, used car salesmen, and dentists who showed up on the cover of Forbes and Fortune in the late 90s, boasting 4-hour workdays, trading on the beach in the Bahamas, and giving up their day jobs due to the cash they were pulling in from the market. That's a whole bunch of BS. Day trading is work. Now, you can successfully be a day trader, and you could eventually quit your job, but you'd have to work very hard at it, okay? Because there's an amount of risk. But the nice thing about day trading, it really means you don't have a position open beyond the current day. Day trading, since the markets are virtually 24 hours a day these days, will allow you to do this evenings and part-time also. But the fact is you have to have lots of qualities. You have to be aware of what you're getting involved in. So the successful day traders I know have been doing it for years. They all trade through retail brokers that everyone has access to, and some of them even do it with as little as $5,000 in their account. Because unless you want to get rich overnight, quit your job, it doesn't matter how much your capital you're starting out with. You start out with a little, you make a little, and you keep making and keep making and keep building that account. You know, it's like that old saying, the guy who puts 1 penny away, then the next day he puts 2 pennies, next day. Eventually, he has a lot of pennies. Well, granted, if you start out with a $100,000 account, and I start out with a $5,000 account, we make the same trades, you're going to end up eventually making more profit than I do, but our percentages will be the same. So you can start out with a small investment and let it grow over time. Now, day trading is not an investment style or a philosophy. It's a level of financial mastery that most will never achieve, but millions desire. Trust me, dig into the deepest, darkest fantasies of even the most hardcore value investor, and you will find someone who wishes they could be a successful day trader. You know, we look and see about Warren Buffett, who makes this huge amount of money. Now, he's an investment trader. He's not looking to go in the market, out of the market in a couple hours. But he wishes that he had something exciting like day trading. And in the darkest recesses of his mind, he would love to day trade. He's even said so. Now, anything that requires focus, drive, discipline, specific skill set, and yes, even at times some luck, it's hard to do successfully. But because the vast majority can't do it, doesn't mean it can't be done. Nor does it mean it shouldn't be attempted, as long as you do it right. And you notice in there, I mentioned a little bit of luck. It's an important thing. It's not a skill. You know, you can see professional poker players in competitions in Las Vegas. These guys know every odd. They can count cards. They know everything's going down. They can read every face. But you know what? The guy who's so good at this still can lose. Why? Because luck isn't with him that day. The cards just aren't coming out in his favor. Same thing with trading strategies. When I was trading agricultures back in the 80s, I mean, for 2 years in 82 and 83, and I was basically a day trader. Okay? Or our version that we had in those days, because we didn't have online computers, we didn't have fast trades. But we were short-term investors. Now, in 82 and 83, I couldn't make a bad trade. No matter what I did, it was profitable. By 84, I couldn't make a good trade. I was still using the same strategies, the same philosophies, the same money management rules, same risk management, still following the same agriculture I've been trading. Couldn't get it right because that wee little bit of luck had moved against me. But if you rode out the markets long enough, that little bit of luck comes back. And as long as you're using good risk management skills, you don't deplete your portfolio chasing your money. You realize when the markets are slightly going against you and you adjust your risk management, you cut your trades back, but you can still stay in the markets. At the end of the day, participating in the market is only one thing. It's about making money. And you should try to make money in the way that is not only the easiest, but historically has the highest chance of success. But life is a bit more complex than markets, and one compelling component of life is the desire to achieve that which most cannot and which sets us apart from the rest. Becoming a successful day trader will bring you rewards that far surpass the majority of market participants, but it is not without risk. Do you know how nice it is to go out with your buddies or to go out on a family event and you're sitting there talking about your day trading and you're almost bragging, but you're so aware of the market, so aware of what's going on around the world, because you have to have all of these skills. You're dealing with social events, political events, money events, finance events, that all of your friends are amazed by you. Your family's amazed by you. You're aware of everything, and you can talk easily in many circles. Now, there's a whole bunch of things you need to follow, though. And because day trading is more about your mindset, the skill set, and the ability, okay? Because you're looking at making small trades that reap small profits on a regular basis, okay? And therefore, there are certain things you must do. Day trading can be molded around a person's current life. However, day trading from home is also one of the most capital-intensive arenas. This is because the minimum equity requirement for a stock trader who is designated as a day trader is large, and this amount must be maintained at all times. If the trader's account falls below the minimum, he or she will not be permitted to day trade until the minimum equity level is restored either by depositing cash or securities. But there are other markets to day trade in that are less capital intensive, and that's the Forex and the CFD market. Because in these markets, you're not marked as a day trader, and you don't have higher capital requirements. So the new advent and new development of CFDs has opened up a huge arena for people to be able to become day traders. Now, potential traders need to be aware of the other markets that require less capital and have lower barriers to entry. The foreign exchange or currency market offers such an alternative. Accounts can be open for as little as $100. And with leverage, a large amount of capital can be controlled with a small amount of money. But don't fool yourself. Opening an account with $100 and trading with $100 will never, ever, you won't be able to stay in the markets long enough. But a $5,000 deposit will put you in the arena to become a good day trader. This market, though, is open 24 hours a day during the week, and thus provides an alternative to those who cannot trade during regular business hours. And for you guys that are in Asia and Australia, because of the shift in times, you actually get a lot more time trading, because Friday night for you guys, which is beginning of your weekend, is still daytime in the Western world, so you can get all Friday night to trade. So it gives you a lot of advantages, because if you're in Asia, you can be trading the main prime times of market when you come home from work. Now, a contract for difference has also expanded. A CFD is an electronic agreement between two parties that involves no ownership of the underlying asset. This allows for gains to be captured for a fraction of the cost of taking ownership of an asset. As with the Forex market, the CFD market provides high leverage, meaning smaller amounts of capital are needed to enter the market. The stock market can also be traded using a CFD. So you no longer, if you want to day trade stocks, no longer have to trade it in the stock market where your capital requirements are high. While the stock is never owned, the contract allows profits and losses to be reaped from speculating on the underlying stock or indice by mirroring its movement. Now, please keep in mind that whether you're day trading, whether you're investing, whether you're doing swing trading, every type of trade in the market requires risk. And the ultimate understanding is understanding risk, understanding profit and loss ratios. This is what day trading is all about, is making sure you get in the markets with the smallest amount of risk and the highest profit potential, and that you understand what that risk will be, because it allows you to stay in that market longer. Okay. You don't want to wipe out your account because you got into too much risk, and that means you have to take emotion out of the trading. High leverage does mean higher risk, but if a trader does not have a large amount of capital, this market can still be entered with very low barriers. educating oneself on the risk involved in building a strong trading plan are absolute must for partaking in trading activity. But when you're highly leveraged, it becomes even more paramount. Now, some of the prerequisites to day trading. So number one, knowledge and experience in the marketplace. Individuals who attempt to day trade without the understanding of the market fundamentals will often lose money. Sufficient capital. One cannot expect to make money day trading. Okay. Day traders use only risk capital when they can afford to lose, or capital they can afford to lose. This does not protect them from financial ruin, but it also helps eliminate emotion from the trading. A large amount of capital is often necessary to capitalize effectively on intraday trading movements. Now, again, you cannot enter the markets with money you cannot afford to lose. Okay. You also cannot enter the markets with very tiny amounts, because a good day trader, even if he looks at making 5 successful trades and 5 losing trades, if he's using at least a 2-to-1 win-loss ratio, 2-to-1 means he'll end up breaking even after those 10 trades, okay, or a 2-to-1 ratio. But there's no guarantee you're going to get 5 losing trades, and then 5 winning. There's no guarantee in what order. You could get 20 losing trades before you get 20 back-to-back winning trades. Okay? So therefore, you need to have enough capital to last in the market, and using the right win-loss ratio analysis. I don't ever enter a trade that's not a minimum of 3-to-1. Okay, does that mean I want to know that I can lose money on 2 trades and my 3rd trade will make enough to offset that? Okay, so it's very, very important that you have developed a risk management strategy. Now, one of the other prerequisites for day trading is a strategy. A trader needs an edge over the rest of the markets. There are several different strategies that day traders utilize, including swing trading, arbitrage, trading news, and are among them. These strategies are refined until they produce consistent profits and effectively limit losses. Now, one of the most important prerequisites or disciplines or requirements is discipline. A profitable strategy is useless without discipline. Many traders end up losing a lot of money because they fail to make trades that meet their own criteria. As they say, plan the trade and trade the plan. Success is impossible without discipline. Now, a lot of day traders, or a lot of beginning traders, don't understand there are 3 decisions one can make: to make a trade, to not make a trade, or to make a stupid trade. Okay. Making a good trade that follows your plan is a good thing. Too many traders, or not making it a trade that doesn't, because it doesn't fit your plan, is a good decision. But there's too many traders that put this 3rd type of trade in, and which is, okay, I want to make this trade, so I'm going to fudge the figures, and I'm going to increase my risk, my risk ratio. And before you know it, they lost their shirts. Okay. So discipline is a very hard thing to have, but you'll find it is the most important quality, better than your strategy. Many traders function more on risk management than they do on any trading strategy. So after the method of trading that best fits you has been decided, the next step is crucial. If trading from home is your main interest, then you must decide what markets you will trade based on your capital and your interest. You must then make a comprehensive trading plan, which is also a business plan, because trading is your business, and decide how you will operate as a trader. From there, explore different online brokers and compare what they offer. Then it's time to start trading. So once you've established that you understand you have to have discipline, you've got the right amount of capital, you start to read and learn about some of the strategies, okay, building a trading plan is crucially important. Most traders don't have a trading plan. When I give a class on just building a trading plan, it's highly attended. Most traders don't even understand what I'm saying. A strategy is one little part of a trading plan. First, you have to decide, especially if you're going to be a day trader, what markets you're going to trade in. Okay? You can't be an expert on the euro, the Australian dollar, New Zealand dollar, as well as oil, gold, and eBay. And people are all over the place. Today, online platforms give you such a broad range. Well, you know what? I trade 6 assets. That's it. Okay. Because it takes a long time to track and watch all 6 assets. And you'll find when you're jumping from asset to asset to asset, type of asset, market type, you're going to end up so lost you're going to make bad trades. So your trading plan starts out with what assets you would trade, what markets you would trade. You could also add to your trading plan, especially for a day trader, what days of the week you're going to trade. That's it. You don't need a trade, and bad day traders are the ones who trade every day and all day long, or every hour is available, or to jump from, they get in the markets on Monday morning because they have a couple hours free, and then they're back in the markets Wednesday afternoon, and then Tuesday evening. It doesn't work that way, because day trading is trading short-term markets for short-term profits. And you have to understand how the markets operate at specific days at specific times of day. The markets have personalities. And you'll find this when you start watching, you might see that euro and gold happen to do better between the overlap from the Asian markets to the European markets. Or maybe gold jumps up every day when those 2 markets are open and then settles back down into the European sessions. But it may only happen on Tuesdays and Thursdays. Okay? Or for instance, crude oil is a little bit more volatile maybe on Wednesdays, because Wednesday's the day the crude oil inventory is released. So in order to do this, this is part of your plan. So you've now figured out, you've got your capital invested, you figured out what broker you're going to be with. Now you've limited down to what assets you're going to trade. You've decided what days and what hours you're going to trade. Well, that's not even the beginning of it all. Okay. You then have to figure out a risk management strategy and a strategy. Now there's many different popular ones. Scalping, fading, daily pivot points, momentum trading are all just parts of it. Okay. And you'll have to stop and learn and decide which ones you like and which ones work best in what markets for what asset and what assets they both affect. Okay. And what is key, because you cannot achieve the understanding and knowledge level overnight. So if you stick with 1 or 2 assets, you might be able to figure some things out about these assets and then figure out which of these popular strategies will work the best and why they work the best for that asset. But it's all about strategy and risk management. Now we have momentum day trading strategies. Okay, I like trading from momentum day trading because I believe more in momentum, because I'm only looking in day trading to make a few points. That's it. I'm not looking to stay in the market for hours. I'm not looking for the euro to go from 119 to 119.44 by tomorrow afternoon. I'm going to see that the euro has momentum to carry it up. And if it's at 119, I don't care. I want to get out with my whatever investment I have to whatever pivot, to whatever risk I've got. And I want to get out at 119.22. I don't care that it went at the end of the week to 119.72. I flipped my 119 to 119.22, so I picked up 22 points less my spread, and I picked up 14 points really quickly. Okay, so momentum is what day trading is all about. One of the first things I learned is that the only way to profit is by finding assets that are moving. The good news is that almost every single day there are assets that will move 20 to 30%. This is a fact. The question is, how do we find them before they make the big move? Before going any further, let's step back for a moment and ask ourselves, what will you acquire from a momentum day trading strategy? First of all, we need an asset that is moving. Assets that are chopping around sideways are useless. So, as the first step for a trader is to find ones that are moving. Price action associated with this event is most always the cleanest. So what I look for specific patterns in charts. I look for triangles that are moving into the point of congestion, because sooner or later they're going to break out and break up or down. and I want to trade that momentum from the break up or down. Or I'm looking at support and resistance lines, and I want to see a break above or a fall below a resistance line. So my favorite is bull flags are a charming pattern. They're a charting pattern. They are a pattern that appears on your charts. In fact, I like them so much, I made an entire page on my website dedicated to bull flag patterns. This pattern is something we see in almost every single day in the markets, and it offers low-risk entries in strong investments. The hard part of many beginning traders is finding these patterns in real time. As a pattern-based trader, I look for patterns that support continued momentum. So what you have to do is learn how to read trend and chart patterns. We have triangles, ascending triangles, descending triangles, symmetrical triangles. We have wedges, we have channels, we have boxes. Then, of course, we have the most famous of them, head and shoulders. Okay, but these particular shapes in price movement can predict the psychology of the markets, and when price breaks out of that center of the triangle, when price is edged into that wedge of the triangle, it's going to break out, it's going to break up or down, and we can judge and calculate what that momentum break should be and trade that asset in that direction. But it takes a little bit of time. Okay. Then also we have Japanese candlesticks, which work very well at giving us pattern. But you have to learn how to read Japanese candlesticks. So you can't just start jumping out and trading overnight. You have to start learning, decide what patterns you want to use. Okay, Japanese candlesticks will take you a lot longer than looking for chart patterns. But then it's setting your risk management, which is much more important than anything. Because if you get it right, you make profit. If you get it wrong, you don't want to wipe out the profit from the trade before. Okay. So I usually set stops just below the first pullback. If the stop is further than 20 cents away, I decide to stop out minus 20 cents and come back for a second try. The reason I use a 20-cent stop is because I always want to trade at a minimum of a 2-to-1 profit-loss ratio. In other words, if I risk 20 cents, it's because I have a potential to make 40 cents. If I risk 50 cents or more, it means I need to make $1 or more to get the proper profit-loss ratio to justify. A beginning trader should be looking at a minimum of 3-to-1. It's much easier to achieve success if I have a 20-cent stop and a 40-cent target versus a $1 stop and a $2 profit. When I'm trading, I try to balance my risk across all trades. The best way to calculate risk is to look at the distance from my entry price to my stop loss. If I have a 20-cent stop and want to keep my max risk to $500, I'll take 250 shares or 250 quantity. In other words, 20 cents times 2,500 will give me a maximum risk of $500. And this is why you need to have a minimum size account. Because trading, whether you're trading 2,500 shares or 25 ounces of gold, okay, you can't, using a win-loss ratio, you have to have enough to make it work. To go in the markets and trade and make $50 isn't even worth the effort. Okay. Now, we want to keep, like I said, significantly, a 3-to-1 loss ratio is my preferential trade. Okay. Now, that means for each risk, I want to have the ability to make 3 times the profit. So in other words, if I'm going to set my stop loss at 20 cents down, I need to see that that trade has a target of 60 cents in profit, or 60 pips, 20 pips. Okay. Now, you don't do this by fudging the numbers, because in any trade, I calculate what my stop loss should be and what my target price should be before I look at, say, okay, what's my win-loss ratio? Because when I finish all of my honest-to-God work, I then determine what my win-loss ratio would be to make that profit and make that stop loss that I've decided would have to work for that trade. And if it doesn't fall in my win-loss ratio, I then don't enter that trade. Okay? So you have to learn not to fudge the data. Take the data, analyze it, and then trade what it says. And if it doesn't meet your criteria, then you don't make the trade. Then you also have to have very smart exit indicators. Exit indicators are different than stop losses, okay, and take profit points. Stop losses calculate everything because the stop loss isn't just 20 cents down, because when you say, okay, I'm going to put it 20 cents down, you then have to go verify and figure out the swing of the marketplace and decide whether you should even make that trade, because if in order to successfully execute that trade, your stop loss to be at 40 cents, because the swing of the markets and the volatility in that asset makes it dip down 39 cents. You don't want to put your stop loss at 20 cents because you're just going to get stopped out even though you were 100% right. So then you're going to say, I have to put it at 40 cents, so therefore my profit has to be $1.20. Okay. Or my profit has to be 80 cents, and therefore my target point isn't 80 cents up, so I can't make this trade. Okay. Now, exit indicators. Now, this is, most people don't understand, there's a whole type of strategy, whole type of trading that's involved in stop losses and take profits. Because you can keep moving your stop losses up higher. In other words, as that asset moves in your favor, and you say you need a 20-point spread to make that trade, well, when that euro jumps up from 119 to 119.15, you could move your stop loss up from the 118.90 or in 118.80 where you had it to 119, because you still have that 20-point swing, but you've also now cut your loss. If it happens to bounce up to 119.27, you can now move it up to 119.07, and guess what? You've now locked in profit, because even if the market's dipped down against you, you've only made 7 pips, so you barely covered your spread, but you've now locked in profit. Okay, so I will sell half when I hit my first profit target. If I'm risking $100 to make $200, once I'm up $200, I'll sell half. I then adjust my stop to my entry price on the balance of my position. Okay. If I haven't already sold half, the first candle to close red is an exit indicator. It tells me to get out of the market. Now, I've already sold half. I'll hold through the red candle as long as my break-even stop hasn't been hit. Why? Because I'm trading with the market's money. I'm already at break-even. Also, you have exit indicator 3. Extension bars force me to begin locking in my profits before the inevitable reversal begins. An extension bar is a candle that spikes up and instantly put my up 200 or 400 or more. I just take my profit and leave the markets. When I'm lucky enough to have a spike up while I'm holding, I sell into the spike. So it's understanding the difference of how you can trade, how you can use order entry types and stop loss and take profit points, as opposed to your strategy for simply entering and exiting the market. So one of the simplest and most effective trading strategies in the world is simply trading price action signals from horizontal levels on a chart. If you learn only one thing from this site or from my webinar, it should be that this: look for obvious price action patterns from key horizontal levels in the market. If you just stick to that formula, you will have plenty high probability trading opportunities over the course of 1 year. Don't overcomplicate the process of analyzing the markets. Charts are finding trades. The market will generate signals for you when it's ready. All you need to do is learn what the signal looks like and where to look for them. If it doesn't already matter which component you find first, the price action signal or the level, what matters is that the two have come together to form a confluent price action trade. When you have an obvious price action signal, like a pin bar or a Fackie signal, and that signal has formed at a key horizontal level of support or resistance in a market, you have a potential high probability trade. So instead of trading chart patterns like triangles or learning how to read candlesticks, you're just looking for specific reactions in the market and using support and resistance. There's also automated trend tracking apps that you can use, things like auto charts. Well, it'll tell you exactly when a pattern's forming and that the trend has just bounced off of a resistance level and is going up. Even on investing.com, they offer all of this. Okay. Now, you have to learn how to use it. You know, sitting there watching your charts to see when it's bounced off of a particular angle, or when it's bounced off a support and resistance level, or when it's breaking out of a chart pattern, can take you lots of hours. There's all, you know, today everything is automated. Okay, it's not making your decision. It's just alerting you that this has happened in the market so that you're ready then to make a decision. And if you develop ways that you can then combine momentum, because this is actually predicting and telling you the momentum's in the market. So key horizontal levels and support resistance levels, or levels on a chart that price made a strong move either up or down. They can be used in any market condition, trend and counter trends, trading ranges. The important thing is we are focusing on in this section is finding a clear price action signal at a key chart level. These levels tend to act like magnets, attracting price to them before prices pushes away again. They can also be taught as value areas, or thought of as value areas, or areas on a chart where price found fair value, which typically happens before a strong move happens. So we're going to look at a chart below for gold. It can show us a very well-formed pin bar. Clearly, the 1170 was already an important horizontal level. So here on the chart, we can see that 1170 was a very clear support level. As we see over the past, this price has been a crucial level to buyers and sellers, where the market is hemmed and hawed at this price. Okay. We can see that here. Now we come back down to the 1170 level, and we see that price cannot break below it and bounces off. So this tells it is a key support level, and we also have a pin bar that breaks above and gives us a buy signal, and we could have entered the market here or somewhere around here and traded it to go up, and we could have made a lot of points. Okay. We could have set our stop loss by the lowest low it had at the previous swing low, and we could have set a whole trading strategy based on simple support and resistance levels and price action. Because again, we don't necessarily need to be very completely right. We need a strategy that's going to give us a signal. Okay, what it is, support and resistance levels. Period. End. Eyeballing support and resistance is one of the best, ways to look at markets. I do whole classes and just call it eyeballing. Okay. Once you have this, all you're looking for is something to tell you the market has momentum to move up. If you've covered your butt with the proper stop losses and the proper risk-reward ratios, okay, you just look for, and as it's moving up, okay, at each level, you're moving up your stop loss. So as price moved up here, let me go back to the previous one. So as price bounced off of here, if we add, let me just clean up these markings here. If we had entered the market, say, in this place, it took us a while to verify that it was, okay, and it moved up here, and we sold off half of our investment here, moved our stop loss up to here. Okay. Then here, it continued up. At this point, we've got our 400-point ratio, so we're selling out of the markets anyway. Okay. But once we had moved our stop loss up to here, from down here, we've locked in our profit. We sold half of our investment, and we've also locked in our profits. So even no matter what happens, we've already locked in that profit and sold the half off. We already got that money in our account. Okay. Granted, this is an unusual move. Gold bounced from 1170 to 1226. But gold's been known to jump 50 points in one day. The next example is a pin bar buy signal that is formed at a key chart level of support. And we're looking at this in the pound. Okay, again, here we're looking at the pound. We're starting to establish a key support or resistance level, and we can see that 1166.556 was a very important strategic level over the past trading few days. Okay. We see that the pin bar, or the wick of the candle, comes all the way down and hits that. That means at some point in that trading session, the bears were very, very strong, but weren't able to maintain, and it closed back up near it entered. Okay. That means price bounced off this resistance level, and it's going to most likely continue up. Now, this isn't going to generate 40 points, okay, but it generates from here. So we could have entered the markets somewhere around here, stop loss around here, take profit up here, and as it moved up to this level, sold half up, built our profit, and kept up in the marketplace. Not very complicated strategies, because day trading isn't about spending days and weeks. Will this asset do this, and will it? You're looking at, will that asset has the momentum? What it's got to do? What does it have momentum to do today in the next short period? Again, trading off of support and resistance is a very simple way of doing this. The main point of this lesson is that you do not need a complicated or confusing trading strategy to find high probability entries in the market. All you need is the ability to recognize price action trading strategies at key chart levels of horizontal support and resistance. If you just focus on this one strategy and really master it, you'll be able to look at any chart of any market and make a high probability trade, because it's not about really your trading strategy. Okay, there's many that will tell you the markets have momentum for a short period of time. Remember, day trading, again, is small profits over a short period of time. It's all about your risk. So, moving average indicators are standard within all trading platforms. The indicators can be set to the criteria you want. Again, moving averages is a simple crossover strategy. You can use a 90-day or use a 20-day and a 50-day moving average. And when those moving averages cross over, whether the 50-day crosses over the 20 or the 20, can give you buy and sell signals. For a simple day trade, we need 3 moving average lines. One set of 20-day periods, one set of 60-day periods, and one set of 100-day. This is mine. You can come up with your own. The 20-day line is our fast moving average. Why? Because it's adjusting to the 20 periods, where the 60-day is our slow moving average, and the 100-period line is our trend indicator. This day trading strategy generates buy signals when the fast moving average crosses up over the slow moving average, and a sell signal is generated when the fast moving average crosses below the slow moving average. So you open a position when the moving average lines cross in one direction, and you close the position when the moving average crosses back in the other way. How do you know if the price is beginning to trend? Well, if the price bar stays consistently above or below the 100-period line, then you know a strong price trend is in force. So in other words, you can see on here on the right-hand side the 3 different moving averages. And what we would use is our 2, which is our fast and our slow, or our 20 and our 60-day, and then our 100-day gives us the trend. And here we have the crossover, here we have a crossover, here we have a crossover, here we have a crossover, each one generating signals. And when those signals are generated, you can then open a position in the direction it is telling you. Now, again, the settings I suggest will generate signals that will allow you to follow a trend if one begins without short price fluctuations violating that signal. Now, again, it's more about your risk management, okay? Because even though something's generating a signal, you have to then calculate the target in which it will move to, where your next resistance line will be, and decide whether it's a false signal or a good signal, and if there's going to be enough profit to make it worthwhile the risk. But they give you extremely good buy or sell signals. So we have momentum indicators, we have chart patterns, we have crossover moving averages, and we have support and resistance level. These are just simple day trading strategies, okay, that you can master in no time at all. Now, scalping is also one of the most popular. Scalping, most of you have heard the word scalping, but don't understand what it is. Scalping is a trading strategy that attempts to make many profits on small price changes. Traders who implement the strategy place anywhere from 10 to a couple hundred trades in a single day in the belief that small moves in the stock price or the asset price are easier to catch than large ones. Traders who implement this strategy are known as scalpers. Many small profits can easily compound into large gains if a strict exit strategy is used to prevent large losses. Scalping utilizes larger position sizes for smaller price gains in the smallest period of holding time. It is performed intraday. The main goal is to buy or sell a number of shares or contracts at the bid or ask price and then quickly sell them for a few cents profit. The holding time can vary from seconds to minutes and in some cases up to several hours. The position is closed before the end of the total market trading session, which can expand to like 8 p.m. Eastern time. Okay. Scalping is a fast-paced activity for most nimble traders. It requires precision timing and execution. Scalpers use day trading buying power of 4-to-1 margin to maximize profits with the most shares in the shortest period of holding time. This requires focusing on smaller time frames, interval charts such as 1-minute and 5-minute candlestick charts, momentum indicators such as stochastics, moving average, convergence and divergence, and relative strength index RSI. Price chart indicators such as moving averages, Bollinger Bands, and pivot points are used as reference points for price support and resistance levels. Now, the thing about scalping is there's many computerized robotic trading that will generate buy and sell signals for scalping. Scalping is a very fast-paced decision. Okay. It requires a very good level of the markets, very good understanding of charts, and a use of lots of indicators, because since you're trying to make small moves, okay, sometimes those moves can be away from you before you've ever entered the market. Okay. And it requires lots of trades. It is a successful strategy for the right type person. It is very intensive, okay, as opposed to trades from using momentum indicators, chart patterns, which are relatively easy. Okay, we've talked about support and resistance, momentum traders, support and resistance levels, momentum trades. Okay, all of these are fairly easy, and you can get lots of trade signals without high pressure. Okay, you can stay in that trade for a short period of time, but it's not generating hundreds of trades a day. Where scalping, you're generating so many trades, you have to be it's a very intensive way to trade. Some of the common mistakes that scalpers make are poor execution, poor strategy, not taking stop losses, over leveraging, late entries, late exits, and over trading. Scalping generates heavy commissions due to the high number of transactions. A per share commission pricing structure is beneficial to scalpers, especially for those who tend to scale smaller pieces in and out of a position. But these are just some of the strategies you can use for day trading. But day trading is quite possible. CFDs and Forexes open up a huge area, an arena for lots of traders. It's a matter of understanding risk management, understanding stop losses, take profit points, having exit and entry strategy, understanding limit or order types, okay, and then coming up with a simple strategy, okay, and leaving your emotion out of it. But it's not very intricate or difficult, simply using momentum indicators or simply using chart patterns. And you'll find it's something you can master in no time at all. It's just not something you want to do 5 days a week and make hundreds of trades at. Okay? You'll find that you can become a day trader if you get your head out of the fact that you want to get rich overnight. Okay? And if you want to make lots of trades. Start out with trading Mondays, Wednesdays, and Fridays. Get one trade in a session. Okay. When you've got some of these together and you've built a smart day trading plan. Okay. You figured out how to understand your risk management and reward ratios. You figured out exit strategies and stop loss strategies. Then you can start adding more and more to the market. You can start defining your plans. Okay. But it's possible. You're just not going to get rich overnight. So forget the hype that you saw years ago. But you can become a successful day trader, whether you're experienced or a novice. It just takes a little bit of discipline and a little bit of knowledge, and you'd be surprised how easy it will come. So thank you again for joining us. Thank you for giving us some time. Thank you for considering USG FX as your next broker. And thank you for being part of the Investing.com family. Have a great day and have a great week. And we'll talk to you again real soon. Bye now.